Rates live with the mortgage calculator. Today we're going to go through some live rates and then do a deep dive into a topic. We'll wait just a couple of minutes here to get started. Let us go live on all the different platforms. We are streaming this on YouTube, Facebook, and LinkedIn. So give us just a moment here. In the meantime, feel free to drop a comment there in the chat. We have the chat pulled up on the screen. So feel free to drop a comment and we'll get started here shortly. Appreciate everybody tuning in nice and early. We'll get started here in just a moment. I see some comments already coming in. Thank you for the comments, Adam, Melvin, Dario. Appreciate it. Good morning, everyone. Good morning to the Mortgage Calculator team. Jason, thank you for the comment. So feel free to keep dropping comments here as we get started and drop any questions you have, especially when we do the deep dive into the different topics. Feel free to drop any questions. But it looks like we are live on all the different platforms, so we can go ahead and get it started here. We'll go ahead and take the chat off the screen so we can get into it. Welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. What we do every morning on this show is go through some live mortgage rates of different programs, and then we do a deep dive into a different topic every day. Now, today's topic is going to be first-time home buyer loans. So our sales manager, Jose Gonzalez, with 27 years of experience, is going to do a deep dive into that topic here shortly. But before we do that, just like we do every morning, we will pull up our pricing tool and go through some live mortgage rates. So, Nick, let's go ahead and pull up our pricing tool and see what the market is looking like this morning.
All right. So this is our pricing tool. This will show us the general rates and APR for today, August 22nd, just after 11 a.m. Most of our programs are live. So we will check that out. We will compare across the different programs using the same scenario. If you'd like a full breakdown, please get with our team members. They can send you a full loan estimate with all of the itemized fees. So as we do every day, we'll set up the same exact quote. 400,000 loan amount, 80% loan to value. We will find the best rate at one discount point in price. We will search for conforming conventional first, then we'll check out FHA, and then we'll go into our expanded guidelines, also known as non-QM, where we have over 5,000 additional programs many other banks or lenders do not have access to. We also have VA and USDA. Those are only for our eligible veterans and service members. If you are eligible, let us know. And USDA is only for eligible properties. If you are shopping in a rural area that is eligible, just let us know. We'll start with conforming conventional, purchase, 30-year fixed, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for every demo, we always use an estimated FICO score of 760 and an estimated debt to income ratio of 40. So with these settings, let's check out the rates this morning. And it keeps going up with all of the bad news. 7.5% rate, one discount point in cost, puts our final APR at 7.667. So if our customer doesn't qualify for conventional for any reason, we definitely want to check out the FHA options. So we'll set up the same exact scenario. We will put FHA. Everything else will stay exactly the same, so we can compare APRs across the programs. And the best option for FHA this morning, 6.75 rate, one discount point in cost. Puts our final APR 7.342. So as usual, in this scenario, if our customer qualifies for both, FHA is actually a touch cheaper. With the recent changes to the upfront and yearly MI that is required. So definitely do not overlook the FHA options, especially as the rates are getting crazy these days. Now, if for any reason our customer doesn't qualify for either conventional or FHA, many other banks or lenders do not have any other options, but we have over 5,000 additional loan programs here under expanded guidelines, also known as non-QM. So when we select this option, everything else will stay exactly the same, but now we have a new box pop up where we can change the income verification. So full doc is 2 years of tax returns. That's what we have to use for FHA and conventional. So typically we'll choose a expanded guideline non-QM program in order to use one of these alternatives, such as asset related programs, our business bank statement programs, our investor programs we'll talk about for investment properties in a minute. Our personal bank statement 12-month is definitely our most popular program. That's what we always use for our demo. We also have RSU, stated income, VOE programs, 1099, P&L, and no income CDFI options. For the demo, we always use personal bank statement 12-month as our most popular program, and that's for our self-employed borrowers. Many times our self-employed borrowers may have issues when they submit 2 years of tax returns where they may not qualify at all because of various write-offs, or just may not quite be able to get enough income to get the home they really want. So in this case, we solved that problem with our non-QM programs using only their last 12 bank statements for income, no tax returns at all. And in this demo, we're determining a debt to income ratio of 40 just using their bank statements. And that's typically the case where most of our self-employed borrowers will qualify for double or triple the income using this method and can therefore get the DTI where they need to be in order to qualify. So with these settings, let's compare the bank statement options. Awesome. So it's almost identical to the FHA APR here. A little bit different rate and cost structure here for non-QM, but pretty cool 7.25 option, 2.625 discount points and costs, so a little bit more spendy. Puts our final APR at 7.371, which is almost identical to FHA, but definitely lower than conventional. Now that is a special option. You see most of the other options here for bank statement. We have hundreds of different options. Some of these are right around 8% rate, and some of these at the higher rates may allow things like bankruptcies, foreclosures, and other disqualifying events that would otherwise cause us to not qualify for a standard program. So tons of different options here. Please get with our team. They'll find the best one for you. And before we have Jose take over, we always want to do our live demo for investment properties as well. So we will set up our same scenario, 80 LTV, 20% down payment for an investment property. And we'll compare our two options, first conforming conventional, then we'll check out our non-QM options. All of the government programs, FHA, VA, and USDA, do not work for investments, so we'll simply compare these two options. Start with conforming conventional. Everything else is going to stay the same as all our other demos. All we've edited is the occupancy. So now we can see the adjustments conventional has added for investments, and it's probably not going to be pretty this morning as it's going to be pretty spendy. Yep. As the rates go up here, or the costs, I guess I should say, unfortunately, the rate does not go up in the same. So 7.5 is the maximum rate here on this program that we can offer. And the discount points are basically not feasible here. 4.625 discount points is way too many discount points to be qualified for compliance, right? So we would never offer this to our customer. But if we did, that final APR would come in at 7.788. So unfortunately, conventional, 80% loan to value, 20% down payment is pretty much not compliant here. This 4.625 discount points is definitely too many, and most investors would not accept this anyway. $18,500 in this example is a ton of money in fees in order to do the loan. So I don't even think anybody could even accept this or offer this at the moment with the way rates are. So fortunately, we have our non-QM options to solve that problem. So for the final demo here, we'll pull it up to the 80% loan to value again, 20% down payment. And this time we'll use an expanded guideline program. So first thing we must select here for expanded guidelines non-QM is our income verification. And for an investment property, we're always going to select the most popular option here, which is the DSCR option. That's because it doesn't require any income or employment from the borrower. We simply use the estimated rent from the property to determine a DSCR, debt service coverage ratio. If the estimated rents from the property can cover the PITIA of the mortgage payment, aka the property cash flows on a monthly basis, that is a ratio of 1.00 or higher. We even have options for ratios under 1.00 where the property may not quite cash flow on a monthly basis. For the demo, as we do every day, we'll put 1.5, which is the highest amount, so we can see all the programs pop up. And the final thing we must select for a non-QM investment property is a prepayment. These are standard for these programs. We always select 3 years as the standard option. There are options for no prepayment that will cost much more and limit the loan programs. And same with 5 years, that will save us some money, but not all loan programs allow it. 3 years is the most common, so we can see all the best options pop up. So with these settings, let's check the DSCR rates this morning. Awesome. So it's about the same as it was yesterday, which is a much better, more realistic option for our customers. 7.99 rate, so a little bit higher rate, but 0.85 discount points in cost. Much more realistic cost here. Puts our final APR at 8.052, so just a touch higher. But again, we couldn't even offer the conventional option for our borrower. In this case, it would exceed all of the compliance tests. So definitely recommend all of our borrowers out there looking for investment properties. Non-QM is the way to go at the moment with the way the rates are, but this is where we specialize anyway. These programs are amazing. We can do multiple loans for our borrowers, no income, no employment needed, and we can cash out properties to purchase multiple properties, so very flexible options. And if we scroll down here to some of the higher rate options, some of these may allow things like credit events, foreclosures, bankruptcies, and other things that would otherwise put us out of qualification. And with the DSCR, we also have a very common request to use short-term rental income. So some of these programs down here at a little bit higher rates may allow this short-term rental income to be used. So tons of different options. Please get with our team to find the best one. Now, let me switch my screen again. And we'll get into Jose's topic for today. It's just going to be first-time homebuyer loans. So typical request for people to use FHA and conventional, but I'm sure Jose has some tricks up his sleeve to use our alternative options. So obviously the conventional government-supported programs are very much intended to foster first-time homebuyers and home ownership in general. So there's a lot of special add-ons and specialty things we can do for our first-time home buyers. But also, as we do every morning, we also have solutions for our first-time home buyers that may not qualify using the standard documentation that is required for conventional. So let's go ahead and make it big, Jose. If you're ready, go ahead and take it over.
Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. So first-time home buyers definitely are a great option right now. First-time home buyer loans, should I say. They have reduced interest rates, and they also have reduced mortgage insurance. And on top of that, one of the additional great features for our first-time home buyer house hackers out there is that they also allow for the purchase of a 2 to 4 unit primary residence at high LTVs, actually 95% LTV, whereas on a conventional, it's 15% down, for example, for a 2 unit on a non-first-time home buyer program. Now, first-time home buyer is somebody who has not owned a property within the last 3 years, not necessarily somebody buying their very first house. First-time home buyer could be a regular 3% down option, or it could be one of the 2 other options, the Home Possible, which is the Freddie Mac option, and Home Ready, which is the Fannie Mae option. Those options do have an income restriction. Typically, they can be no higher than 80% of the area median income for the census tract where the property is located, unless it is a low to moderate income census tract, in which case then there is no income limit which is a great deal. So we have some great purchase options in these programs because they are not for cash out refis. They're only for rate and term refis. They're really meant to promote home ownership amongst those who would otherwise possibly be priced out due to the higher rates or higher mortgage insurance that they could find. And you'll see when I show you the rates that I have, you'll see how much better they are than the standard rates that you just saw a couple minutes ago. They also offer a great deal for manufactured homes as well. So let's get to our first purchase example here. Now, in this one, this is the one with no income restrictions, not home possible, not home ready. The MI factor is 0.35%. So in this example, our $500,000 purchase, the mortgage insurance is $141.46 at a 97% loan to value. So you could see here 7.875 has a lender credit of $970, and you can buy it down all the way to 6.875. So this is a 97%, and it's also for a one unit property. Now, this example here is our Fannie Mae Home Ready option. And you can see now how much better the pricing is. I selected options with basically my highest rate here has the highest lender credit, a little bit over 1%, to give options where, we could add some additional funds to close for our first-time home buyers, which are usually going to have a little bit less money available. So here, due to the better pricing available with this program, there is a lender credit at 8% of $5,335. That's over 1%. That's a good chunk of their closing costs right there. And you can buy it down all the way to 6.625%. And this is for a one unit. And the mortgage insurance on this option is the factor is 0.25%. So you see it's reduced. The other regular 3% down has 0.35%, which is standard. And that translates to $109.13. So almost 34 something like that dollar difference between one option and the other. So our Freddie Mac Home Possible, same exact rates, no change in going Fannie to Freddie as far as the rate, but the same differences hold that hold for regular quote unquote Fannie and Freddie loans. We like using Freddie Mac for our self-employed borrowers because it's more flexible income calculation for a self-employed borrower when using Freddie Mac. Also, the self-employed borrower has been in business for at least 5 years. You automatically get the 1 year tax return findings. And also, Freddie Mac only considers a 0.5% of the total balance as the payment for a deferred student loan. So those probably would be the three main reasons that you would use Freddie Mac over Fannie Mae. Besides, every now and then you may get automated underwriting to approve one over the other due to the different algorithms when they are assessing the risk. But the three main reasons why you would straight out pick one over the other are the reasons that I mentioned. So this is for our one unit. Now here's where it gets pretty interesting. I mentioned our first-time home buyer house hackers. When you're buying that first property, this would be a great option if it fits into your family's objective here, because this is probably the only time that you're going to get to buy a 4-unit property, for example, with only 5% down. Once you own that first property whether it's a condo, townhouse, single family home, it's going to be difficult to convince an underwriter, pretty much near impossible, that you're going to live in a 2 to 4 unit property. And you will note the best news here is that the rates pretty much are the same. There's like $110 difference in the lender credit, so a slight difference in the premium, but the rate is the same, 8%. Lowest cost option, 6.625%, lowest rate option. And the MI, since it is 95% LTV, they don't hit you for any adjustments due to the fact that it's a 2 to 4 unit. So the MI is only $84.88. And our Fannie Mae Home Possible option, same cost, same rate. Again, no difference from Fannie to Freddie in the rates. And usually there is not. Sometimes you get like a 0.125 difference in the regular programs. Here's another nice one. Manufactured homes at a 97% LTV. And this is using the Manufactured Home Advantage program, which is a program for manufactured homes built 1990 and after, right? So that's the key. If it's before 1990, you will not qualify. The manufactured home will not qualify for this program. Same mortgage insurance as the other 97%, no add-on for it being a manufactured home, but you do get a little bit of a rate adjustment due to the property being a manufactured home versus a regular built structure. So here you're looking at 8% at par, whereas the other one offered you at 8%, 5,335 and 5,225 respectively. This one is par rate at 8%, and you can buy it down all the way to 7.25%. And last but not least, I wanted to give you a rate and term example because cash out refinances are not applicable for the Home Ready or the Home Possible program. This program is meant just for, like I mentioned, home ownership. So again, over here, you're looking at the same rates that we had for the 1 to 4 unit purchase, 5335 lender credit at 8%, and you can buy it down all the way to 6.625%. So again, great options here for your borrowers looking for conventional financing. We in some markets we still have tight inventories. If your borrower is putting forth an offer financed by a conventional loan instead of an FHA loan, that may be the deciding factor to your borrower's offer getting accepted. So I always recommend that you discuss with your realtor partners who are familiar with their local markets and with the offers that are, what is the reception to FHA offers, to conventional offers. I always recommend, when possible, pre-approving your borrowers for both, right? Conventional and FHA, and then seeing which is the one that gets accepted, because typically, at least in our local market here, they still tend to be favoring conventional offers instead of FHA offers.
All right, so those are all the government programs for first-time home buyers with a bonus, basically, right? So
correct.
Government offers a bonus. Remember, we still have all the non-QM programs. There's just no bonus offerings per se for all of our non-QM stuff. So you can use it. You can still use a non-QM program if you need help. But all of these options, if you qualify, 2 years tax returns, as we mentioned, these great bonuses are there for our borrowers. There's also income limits on almost every option. I believe there is on every single one that you presented there, Jose.
There is, except for the very first one, which was just a 3% down first-time home buyer, not home ready, not home possible.
Yeah.
What I also wanted to add regarding the home ready and home possible, that they are great options because they allow combining them with a community second, which would be a second mortgage issued by a municipality, state, county, religious organization, their employer, which typically do not have a payment. It's usually a deferred payment where it is paid off when they either leave the property as their primary residence or when the property gets sold or when the loan gets refinanced. So that's another of the very popular features that these two programs allow, up to 105% CLTV when you're combining it with a community second. So that's really where the first time home buyer option really gathers momentum. There is when you're really using those programs. However, now those programs, the loan then will be limited by whatever underwriting requirements those community seconds have, and they are definitely income and asset based. So whereas your borrower may qualify for, 400 or 450, going up to 80%, or maybe they're in a low to moderate income census tract, so there's no income limit. But then you have to see that if you're combining it with a community second, there will be definite income restrictions on those programs.
Which goes right into the next question. So Sonar was asking about DPA. So the conventional, it's a little bit different with the DPA, but you just explained the different options, which would be typically a DPA program as a second.
There's other options too, like Hometown Heroes, for example, but that one's even more restrictive because that one offers up to 5% of the loan amount up to $35,000. So it's a nice chunk there, which is also deferred payment. And then, there's other options here. I didn't put them as in the first time home buyer with these quotes because it's really, you'd be talking about FHA, combining it with all the different down payment assistance programs that we have, which is not restricted to first-time home buyers. But as you will see tonight in my presentation for first-time home buyers, it is a very good option for first-time home buyers because first-time home buyers isn't just categorizing your first-time home buyer to see what they can get. It's really realizing that most first-time home buyers, since they are buying their first home, do not have substantial savings like somebody that may be selling their current home and they're going to be pulling out a lot of nice equity, and now they're in their second home and they're giving 10, 15, 20% because they built up some nice equity from their first home. So typically the first time a home buyer, we usually try to help because they had to scrape up everything that they could get to get that first home, hoping that then 5-7 years down the road they have equity and they'll be in the same position to buy their next home with a nice big down payment.
All right. I don't see any other questions, so I think we are good to go. Thank you, everybody, for tuning in. Great topic here today. Definitely something you will use a lot for those of you, especially working with realtor partners and getting people pre-qualified. Remember, we do this show every weekday, 11 a.m. Eastern, where we go through the live rates and do a deep dive into a different topic. So we'll be right back here tomorrow with a new topic. Appreciate everybody tuning in. Thank you, Nick. Thank you, Jose. And we will see everyone tomorrow, 11 a.m. Eastern, for the next episode of Daily Rates Live with the Mortgage Calculator. Everyone have a great day.
Thanks, everybody.
Thank you, everybody.